Hey everyone, my name is Gaurav and welcome back to my channel. Today I'm going to give you a very simple but very practical investment thesis framework which will help you to understand what exactly moves the earning of a company. A lot of people start researching a stock quite randomly. So they will go to the screener, put their company name, look for a couple of ratios, maybe watch a video or two, but they don't have a clear structured framework and a key questions to ask to do the analysis of a business. And that's why investment thesis framework is very important to have. It will solve two problems. First of all, it will help you to structure your thinking, which is very important as of today. And then second, it will also helps you to follow a clean thread instead of randomly jumping from stock to stock and opinion to opinion. Now, this presentation might feel a little bit concept heavy and text heavy, but since this is a fundamental analysis, we have to focus more on clarity rather than speed. And later at the end of the video, I'll share a simple checklist framework with you to analyze any of the company. With this, let's go deep dive into those concepts. So my entire objective of this video is to simplify investing for you. As you know, right, I always keep on repeating, I hate noise, I hate randomness. If something not structured, then it will give you a massive headache. So if you remember just one thing from this entire video, it should be this equation. Now, this is the mental model I personally use for every investment thesis. Every catalyst, every story, every narrative must map to this one equation, which is earnings equal to revenue into operating margin, excluding all the leakages. That's it. Why this equation matters? Because we as an investor generally fail because we don't have any starting point. We start jumping from news to news, social media to social media, stock to stock, opinion to opinion. We don't have a proper framework. And this equations forces structure. It gives you a framework which you can use immediately. It simply tells us that will revenue increase or decrease, will margin improve or not, and are there any leakages which is eating earning. It simply eliminates story investing. It eliminates vague great management narrative. It just cut out sector hype, and it prevent any valuation only analysis. So because none of these matters unless earnings actually improve. Now of course in next couple of slides I will try to break down this equation. Okay, now that we have understood the earning equation, let's slow down and break it step by step. So we said earnings equal to revenue into operating margin minus leakages, right? So this is the one formula, one equation you have to always remember while analyzing any of the businesses. Now before we talk about other two bit like margin and leakages, let's first discuss in detail about the base, which is revenue. Because if revenue doesn't grow, nothing else really matter, right? So that's the main key operating part of entire business. So we want revenue to grow. The right question is, how exactly will the business sell more? Now there are multiple levers via which company can increase the revenue. So one is like capacity expansion, which is supply side equation. This is the most basic and cleanest lever. So when company spends, let's say 300 or 500 crore, it's just not a story. I mean, there is a chance that capex will get converted into a revenue eventually. Now comes the second lever, which is capacity utilization, right? So many people mix this up with your capex, which is capacity expansion. Here company already has the capacity, right? And but it's running, let's say, around 40-50% of utilization, and as suddenly the demand improves, utilization moves to 70-80-90% without any new major capex. So this really helps revenue to grow. The third is industry cycle tailwind. So sometimes company does nothing special. The capex is there, utilization could be efficient around 70-80%, and suddenly the demand, the industry itself turn. So for example, power transmission, defense, railways, renewable sometime back. So when these cycle turns, order inflow automatically starts coming in. The fourth is order book visibility. Order book is little dangerous lever if you're lazy, and in separate video I will definitely discuss in the detail how to analyze this one. A 10,000 crore order book means nothing unless execution is done properly. The next is new product and new market. So for example, company supplying industrial motors enters into EV component. So here revenue growth comes from new addressable market, right? So not just a higher share in the old one. So the next is regulatory or policy driven demand. Sometimes revenue grows because policy forces it. So government mandates, PLI schemes, or import bans, right? They create artificial demand for short period of time. And the last one is client base, right? So suddenly the client's base expansion happen, moving from one or two large client to multiple customers. So the one important point for us to remember from the revenue lever point of if you are trying to identify the revenue levers, that if any of the factors doesn't clearly increase the revenue, it is not catalyst. And if you don't know which are the factors affecting the levers, just remember these five or six which I have mentioned. They will always help you to ask right question while you're reading con call, annual report, and trying to identify right levers for revenue. Now that we have understood how revenue grows, the next question is even more important, which is how does the business earn more per rupee of revenue? And this brings us to the second part of the earning equation, which is operating margin side of it. Earning are not just about selling more, right? They are about to keeping more. So let's talk about the margin expansion levers. The first and most powerful lever is pricing power. So if a company can increase price without losing volume, margin expand instantly, right? So for example, a niche industrial player with a strong client dependence suddenly increase price, let's say by 5 to 7%, because customer cannot easily switch, and for them to pass on that price to the customer is quite easy. The second is operating leverage. This is one of the deadliest lever. I mean, in last few years there are many companies where we have identified operating leverage in progress, and that stock has really done well from the price action point of view too. This basically kicks in when the fixed cost stays flat but revenue rises, right? Now the third is product mix upgrade. Suddenly companies started selling high value product and moved towards a premium product instead of commodity products. Now revenue may grow modestly, but margin expand immediately. So for example, moving from a standard transformer to high voltage or export grade transformers. Same factory, same client base, but better margin profile. Yeah. The fourth one is process automation and efficiency. For example, labor cost as of today is, let's say, 12%, but after applying some automation and efficiency tools, it dropped to 8 or 4%. Obviously, this will immediately benefit the margin, or removing any bottlenecks which is impacting the margin. That could be another way to address this. So fifth one is input cost normalization. So sometimes margins are depressed due to temporary spikes in raw materials. And sixth one is regulatory or policy margin protection. So sometimes government creates such policy like anti-dumping duties or minimum import price, right, which benefits the local domestic players. Which now margin expansion is again not a magic; it's quite mechanical. So either the company they charge more, sell better products, spread fixed costs, cut inefficiency, or benefit from policy protection. If you can't clearly identify with these which lever is working, margin expansion is just hope. Now that gives us EBIT, the first part of the equation. But here is the problem that not all the profit reaches to the shareholder, right? Or the investors. So this brings us to the second part of the equation, which is leakages. So why leakages analysis matter? Because the key purpose of this analysis is quite simple. Once the business starts generating operating profit, it's company's job not to just grow earning, but to protect what is already being created. Now leakages are the place where the profit quietly disappears before they become clean and reaches to the bottom line, which is our EPS. So the question is not that if EBIT is growing or not. Of course, that's the important part. But then real question is that how much of that EBIT is safely reaching to our shareholders. Now, what are the primary earning leakages? The first one is interest leakage. When a company funds growth using excessive debt, a large part of operating profit goes into interest payment. There's a company which has done a massive capex and their operating profit today is less than 1900 crore, and they are paying off in interest and depreciation approximately 800 crore, which is almost 35-40% is being wiped off from the operating profit, right, immediately. So that kind of thing we don't want to see. Secondly is working capital leakage. So high receivable or probably bloated inventory trap. The company shows profit on paper but keeps borrowing to fund their day-to-day operations. That is again a silent killer of earning quality, right? The third is tax leakage. Sometimes profit looks quite good because of tax incentives, but the moment that incentives end, tax rate normalizes and EPS growth suddenly slows down. So these are not very structural catalysts, although they could act as a catalyst for short period of time at the moment incentive being announced, but then these are not a structural catalyst. So that is very important for us to understand. One-offs or accounting noise, for example. So what I mean is like asset sale or exceptional item, they immediately inflate the profit for a year or two again, but they do not reflect core earning power. Poor capital allocation, again, it's a very dangerous leakage, and especially bad capital allocation. Low return capex or value destructive acquisitions, they immediately consume cash without creating a good amount of return, right? So, for example, debt reduction that will immediately improve the APS quality. If across the cycle, if good amount of PAT is getting converted into the cash, so basically cash flow from operations should broadly exceed from PAT over the time, and that is a good sign again. Then improving working capital days, faster receivables, leaner inventory, then stable or improving ROCE with control asset growth. Again, it's a good sign. Capital discipline, if capex backed by return, not ambition, and not doing at the bad cycle. A lot of companies in the chemical space have done the capex at wrong point of chemical cycle, and they are severely being punished. So far we have built the framework. So we understood the earning question, and we broke down revenue levers, margin levers, and we also understood leakages and earning quality, right? Now the only real question is, how do we apply this in real world, right? Theoretically looks good, but let's try to apply this in the real world. So let's take a plain case study, no buy call, no recommendation. And this is purely to show how the framework works end to end. Whenever we are analyzing a company, we simply start with one simple question: what's the business model and what company actually do, right? So for example, Force Motor, they operate primarily in light commercial vehicles. So the key segments are traveler and Urbania vans, school buses, ambulance, and basically here they have 70% market share, and that shows that they are kind of a market leader in this sector, in this category, right? So this is more of a utility-driven product. These are not very glamorous or luxurious-driven products, but it's a stable demand business. Okay, there are other elements like they supply engines to Mercedes-Benz and BMW, and they exited the tractor business in 2024. And the last part is that they are planning to do a capex of 1500 to 1700 crore over the next 3 years, and mainly funded by debt and internal accrual. Once the business model of Force Motor is clear, now we move to the catalyst phase. A very quick disclaimer before I go further in detail. I have tracked this company for a while and initiated a core position in early 2025. So this is only to explain how the framework is applied. We start with the catalyst one, which is your revenue side of the equation. So let's start with the industry cycle tailwind. So post COVID, commercial vehicle demand started coming across. So basically low commercial vehicles, buses, ambulance, engine supplies, and this recovery was driven by basically mobility normalization and infrastructure spending. Force Motor, with close to almost 70% of market share, they being the market leader, they were positioned exactly where the demand returned first to them. So if you look at the income statement image which I have here, so in COVID, the demand immediately collapsed and the sales dropped to around 2000 crore. But then later on, steady revenue recovery happened in fiscal year 23, 24, and 25. So this basically shows that industry tailwind created some opportunity for this business, but it did not create earning on its own, right? So this gave the company the initial push, yet it has not created earning on its own, right? So which brings me to the next catalyst, which was capacity utilization, where earning actually come from. So during fiscal 2021, revenue collapsed, as we just said, right? But the company did not shut plant or cut any long-term capabilities. So your factories, tooling, research and development machine were already in place. There was no major capex during the downturn, right? They were waiting for the demand to come, and they weren't sure if the demand will be back or not. But post COVID, when demand came back, Force Motor scaled up by restarting existing capacity, not by adding new supply. And that is very important. We always tend to think as a retail investor that capex is the primary catalyst for any of the company to grow, but sometimes company can still grow without doing capex if their capacity is not being fully utilized. Exactly same thing happened in Silchar. Silchar was initially underutilized with 40-50%, and then when the demand came in, they already were ready with all the capex and everything. And when the demand came back, they immediately ramped up their utilization and moved from 40-50% to 80-90, and now pretty much fully utilized. And exactly same thing is happening in Force Motor. When the demand came back, Force Motor immediately scaled up by restarting the existing capacities, and that's why operating profit grew faster than revenue. Catalyst 1 is a straightforward. Industry recovery brought the volume back, right? Your existing capacity absorbed that demand, and utilization improved and revenue followed, right? So that's the initial catalyst one. And this brings to the impact. So impact was massive. Revenue growth from past 3 years is approximately 128%, which is double digit CAGR in post fiscal 2021. Now, the second catalyst which the Force Motor had was the operating leverage. Before I go into the story of operating leverage for Force Motor, let me quickly explain you what the operating leverage is. If you look at this image, on the left you see a high fixed cost, that bag of money, that basically represents the cost that the company must pay no matter what. So, for example, your factory rent, your machines, your salaries, your maintenance, these costs generally do not change. If you sell 1 unit, 10 unit, or 1000 unit, these costs will always be there. Now, if you look at the arrow which is marked revenue, when the revenue is low, those fixed costs feel heavy, right? Most of the money just go in covering the fixed costs. So very little or less profit at that point of time. So, but as revenue start increasing, since your fixed cost won't increase in the same proportion at the same speed. So when revenue goes up further, more money flows to the right side, which is this side, and the larger part of it become operating income. Now that rising green arrow shows this effect if you see at the right hand side of it. So in a nutshell, your operating leverage is nothing but once a company has a high fixed cost, every extra rupee of revenue after a certain point of time adds a very high profit to the business. So with this, I'll take you to the second catalyst, which was operating leverage story. So let's first understand what exactly went wrong. So during FY 2021, COVID hit the commercial vehicle cycle, right? Very bad. Now demand collapsed, movement stopped, and commercial vehicle volume dropped sharply. Now Force Motor already had factories, R&D, tooling, machines, everything was in place. But suddenly, since the demand went down because of the COVID, those factories were running far below capacity. So what now we have is underutilized capacity. If you look at the income statement, revenue fell sharply from around 5,000 crore to approximately 2,000 crore in FY 2021. But the cost did not fall in the same proportion because fixed costs don't disappear just like that. Even if the demand goes down, your fixed costs will still be there. So factories still need to be maintained, employees are still need to be paid. Because of this, the margin collapsed. Operating profit dropped to almost nothing. Now this basically sets the base, right? Now post-COVID, which is around fiscal 22 onwards, the cycle start turning. Suddenly the demand of vehicle increase, basically mobility normal. Now Force Motor did not add any new factories here. They had no big capex plan and no aggressive expansion. They simply started running the same plant harder. And if you look at the income statement, the numbers show it very clearly. So revenue grew from 2,000 crore to around 8,000 crore, which is almost 4x. Now this growth came mainly from volume recovery, not from price hike or any expansion. So same cost base, higher volume, better utilization. Very simple, right? And now this is where the operating leverage really shows up. Now let's quickly look at the common size P&L. The fixed cost is not increasing in the same proportion as the volume is increasing or the revenue is increasing, which means the fixed cost is already been absorbed. So every additional vehicle sold now carries much higher incremental profit. And that's what we look into the numbers also. So if you see, operating margin earlier was hardly 1 to 2% in down cycle, and it later on moved to 12 to 13%. Which has caused operating profit to jump from 24 crore to 1000 crore, which is almost 40x, 40 to 45x, right? So do you understand the gap here? Like if you understand the gap here, revenue went up 4x, but the operating profit went up 45x. Now that what we call is operating leverage. Now let's come to the last part of the equation, which is leakages. So far we have discussed revenue growth and operating leverage. So in the Force Motor case, the biggest leakage was earlier debt. So before the recovery phase, around fiscal 21-23, they had decent amount of borrowing, which means high interest cost, cash flow getting diverted, and profit leaking was happening. But here's the key management decision: as the cycle turned and operating leverage kicked in, and after selling the tractor business, whatever the fund they got, instead of doing aggressive expansion, because the demand started coming in, they first decided to settle the balance sheet, repair the balance sheet. Right now the balance sheet is pretty much clean. So once the debt reduced, basically three things happened. Interest leakage collapsed, right? Operating cash flow immediately crossed to 1000 crore, and ROCE, which is return of capital employed, improved to almost 30%. Now whatever earning the business was generating, a large portion actually was reaching to the shareholder, and that is why the market is starting rewarding to the stock price. Now let's quickly connect everything what we have discussed fundamentally with the price behavior. So if you see the left side of this chart, which is phase one, basically from 2022 to 2024, this was the fundamentally inflection point, right? So all your revenue as a catalyst, operating leverage, and debt being settled was happening at this point, at this phase, right? Post 2022. And the market rewarded immediately. Within a year, the stock moved, to almost 5 to 6x. Then comes the phase 2, which is your April 2024 to 2025. After a sharp 5x, 6x kind of return within a year, stock will definitely need to do some digestion. So earning digestion as well as price digestion. So stock went into sideways almost for a year. And this is where the point where the institution reaccumulate these stocks. So if you see in the bottom volume, if you see this yellow bars, these are the pocket pivot on a weekly chart, which means institutions are kind of accumulating the stocks, and you won't see a lot of big purple bar, which is your selling bar, and that's a good sign, right? Within the base, if you see these kind of accumulation happening, then a stock basically reaches to the right side of the base where it formed a small mini base within the base, and that become our entry point. Now one point I wanted to highlight over here is, if you see in the phase one, a lot of fundamental inflection points already been happened, and that was the ideal entry point, right? Investors who knows this company in and out, they might have invested in that phase, right? And they made a good amount of money. But when this correction happened, or this sideways action happened for a year, this could be a potential entry zone for other investors. The reason being, your risk reward got reset. Now if you're analyzing a business, the business is clean because debt has already been cleared, your operating leverage is already happening, your revenue catalyst, which is your sectoral tailwind and capacity utilization, that has already been there. So all those catalysts which we have identified so far is already active, right? So for an investor like us, it's quite a clean company to invest in. So that is why it becomes quite attractive at this point. And after that, basically phase 3 started after a long base, because risk reward is now reset, and stock broke out again. And mainly the earnings are stable, balance sheet is clean, confidence is higher in this company. So the next leg is started, and from there on, from the clean entry point, I think stock went from 2 to 2.5x. So now I hope you might have understood how to use that equation to build an investment thesis framework. Now I'll just quickly show you that checklist which I was talking about in the start of the video. So if you look this is a checklist I built directly from the framework you saw in this video. So the earning equation, the operating lever, and as well as the leakage checks. I have added all the key questions here, the one you should be asking when you are analyzing any company. So you don't need to memorize this. Basically keep this in front of you and just follow the process. I've also attached this checklist in the description for you to download it, save it, and execute it. Now my suggestion to you is very simple. In the last video, we ran a scanner, right? And we identified few companies. So I want you to go back to that video, run the scanner, and identify 2 or 3 companies, and simply keep this checklist and equation in front of you, and focus on identifying the catalyst which is now getting active in those companies. Don't rush to conclusion. Don't try to find an answer whether this company is investable or not. Just focus on to identifying what are the key catalysts, whether it's coming from revenue, operating margin, or by avoiding any leakages. Which are the key catalysts working on that company? And practice this with 3 or 4 businesses. I'll promise you it will immediately help you to, first of all, create a framework in your brain, and secondly, it also start giving you an idea how to quickly analyze a business. In the next video, we'll try to build on this. We'll try to discuss the details of capex and some of those levers which we discussed, and also we'll try to understand which are the tools we generally use it to do this deep dive analysis. Okay, so thank you so much, and see you in the next one. Take care. Bye.